How much was new just now out of Williams?
I think it's interesting to see them stepping back the language right here. I think there may be a recognition within the Fed, if Williams is out there saying this, that the way it came across on Wednesday was a little bit not as nuanced or subdued as they wanted to come across. I mean, we had almost a 3% swing essentially in the markets, which is a really big reaction for a Fed meeting. I don't think that's exactly what they're really intending to have in the market. So the walk back makes some sense to me at this point.
And Lori, I guess, if it were just the Fed that were weighing on this market, maybe that would have had a larger effect, at least so far, not necessarily that dramatic. If you look at anything in the way of the market behavior, whether it's how oversold things are, the valuations, you're going back at least to early 2016, maybe to 2011. Is the call just recession or no recession in terms of how this market goes from here? What do you see the fundamentals saying?
Yeah, absolutely. The problem is that nobody really knows what the trajectory is. In fact, our core thesis is that we'll see some slowing, but we'll still have a reasonably good 2019. But the problem is that the tails around that have gotten a lot elevated, whether it's concerns about the Fed language. I mean, there was effectively something for everybody to not like in that statement, or whether it's Trump and some of the things that he's calling for, or the government shutdown. So the problem is that all of a sudden the core thesis is in question and the tails are a lot bigger.
Jason, given everything else that we've been through this week and in the recent quarter, how much does the action out of D.C. matter? The increasingly likely government shutdown, the Mattis resignation, does that factor in here, or is it noise you ignore?
So I think the way I would be thinking about this is the government piece is a little bit of noise on top. It's like the cherry on top to all the different problems that we're grappling with. The Fed's been tightening. We're going into a cycle where they're starting to get really close to what they think is neutral, and there's always that possibility that they step over a little bit. To kind of put into bigger picture context here, we're in the 9th year of an expansion. We put in place last year a recession model internally to try to gauge what's the probability of recession in the next 12 months. It's not a perfect indicator, but it gives us an idea of the risk. That recently popped up to 35%.
In 12 months?
35% in 12 months. Now, let's think about that. You have to. That's a yellow light, not a red light. Right? The thought process is that 1 in 3 chance. That's not a base case. That means 2 in 3 chances. We don't have a recession. We keep on going in this expansion. We extend it further. But a third chance is higher than what I like to see typically. Typically majority of the cycle, and in fact, through the majority of this cycle so far, that recession indicator had been showing sub 20% numbers. Right now, we're seeing 35%. That indicates, I think, an expansion that's ongoing, but one that has its fragilities, one that if you have the right combination of factors that hits it the wrong way, we could see a technical recession. And obviously, markets don't like that. And I think that's what investors are feeling, what's reacting to today.
Corporate profits go to zero in 19?
I don't think corporate profits go to zero in 19 in that environment. I think I would probably posit the idea, given that it's a 35% chance, in other pre-recession periods, we've seen that indicator hop up into the 70, 80% range. I think it's hitting 35% because there's this chance of a technical recession. But the recession would, if it were to come about, would probably be light in magnitude because we just don't have that much in the way of excesses built in the system for us to pull back from. So it'll be the light in magnitude, and corporate profits, if that were to happen, might actually hang in there surprisingly well.
Do you agree with that? I mean, people say, oh, be glad housing has not become an excessive size of the economy, but corporate debt's up 65%.
A lot of the shorter cycle signals have been bouncing all over the place. So similarly, we've got certain indicators that are flashing a lot more red than they were even a couple of weeks ago. But literally next week or the week after that, they could be back in more of the yellow amber zone. So we're not worried about recession, certainly in 2019. And if you look at corporate profits, they're likely to come in around 8 or 9%. So what's really happening here is that risk premia are resetting. And at these levels in the market, we actually think it's a pretty interesting entry point.
Entry point for equities down 15% in 3 months.
Absolutely. And in the U.S. in particular, where we still think, despite all of the geopolitical tensions, the U.S. is still the least worst house on the block.
With tariffs going to 25?
Even with tariffs going to 25. And again, this whole trade dispute can continue to accelerate, which I think is one of the big things that is weighing on global companies in particular. But on balance, we think that we'll get through it. And with this, we'll look back and think these were good buying opportunities.